Hi, I'm Sam Hawley, coming to you from Gadigal Land. This is ABC News Daily. You may have enjoyed a spot of shopping on the weekend, but if you're still heading out to spend up big, you're among a diminishing crowd. We now know there's been a huge slump in consumer spending as more and more of us find it harder to make ends meet. Today, the ABC's business editor, Ian Verinder, on where our economy's heading midway through the year. Ian, let's talk about David Jones, because last week figures that would normally be kept secret, I think, were leaked to the public and they weren't pretty, were they?
No, Sam, they weren't at all. David Jones is now a privately owned company. I mean, it's had its own, I guess, hardships and travails over the years. Mm-hmm. You know, the South African-based Woolworths bought it about a decade ago, paid $2.1 billion for it.
Gosh. Sold
it a few months ago for $100 million. So basically wrote off $2 billion on the deal. So, you know, department stores have been in decline, but it's now owned by a private equity group, so they don't have to reveal any results at all. What the results that were leaked did show, though, was a dramatic drop-off in sales.
185-year-old David Jones has seen trade plummet. Leaked data shows total sales for the first week of June were down about 10% compared to the same time last year. Major stores in the suburbs saw trading decline by as much as 23%, and there was more pain in the regions, with sales plummeting almost 40%.
And I guess that's important for us to think about, because clearly what's happening now is that the 12 interest rate hikes that we've seen from the Reserve Bank are obviously starting to filter through the economy, and in quite a substantial manner. And you have to bear in mind that household consumption is essentially the economy. Yeah. It makes up about 60% of GDP. So when you start to see a drop-off in household consumption, essentially GDP figures are following.
And of course, David Jones, it sells things that are discretionary. We don't need the things from David Jones. We like them, but obviously we can't afford them right now.
Yeah, and that's the important distinction too. You know, we're still buying the things we need, but we're not really, shelling out for the things we want. If your mortgage repayments have jumped by $1,800 to $2,000 a month, and that's pretty much the case in a lot of examples in the big capital cities, then, you're going to have to try and economise somewhere, and it's going to be on the luxuries, really, isn't it?
Yeah, exactly. Back to that point, Ian, that these figures, they're normally private figures for David Jones' eyes only. The fact that they've been leaked, is that telling us something, or is someone trying to tell someone something?
I think so. I mean, who would have those figures? Only a handful of people. And I think the message from within the figures even was that the hierarchy running David Jones was trying to send a message through to the Reserve Bank that perhaps they should start to moderate the rate hikes, because it clearly is starting to have an impact. And, what the figures showed was sales down 10% nationally, around about 20% across the suburbs, and in the regions, particularly hard hit there, sales figures were down 25 to 38% in one case in the regions there. So, clearly the rate hikes are starting to have a really big impact.
So is it just David Jones, Ian, or is this across the board in retail?
I think you're seeing it across the board in retail at the moment. The Commonwealth Bank released a little report the other day. Now, obviously, they've got access to how we spend our money, where we're spending our money. And it's quite interesting, really. Now, they are definitely noticing a marked pullback, they say, in certain areas. Travel is one, entertainment off about 8%, and retail very soft, they're saying. And out of household spending, only food is really on the rise. Clothing is down. Consumer spending generally is weak, they're saying, and they expect to see further weakness as more rate hikes hit.
All right, Ian, so let's have a look then at what this rapid drop in sales means for the economy. We know it's linked to the interest rate rises, the 12 rate rises we've seen.
Another month, another rate rise.
The cash rate has gone up to 4.1%.
But what does it show us about where our economy is heading more broadly?
Well, when we think about our economy, we often think about all the things we export, the raw materials like iron ore and coal and gas and food commodities as well, rural commodities, wheat, meat and everything else. But really, most people don't realise that it's our internal consumption that is the biggest component of economic growth. And so when that starts to slow, as it is slowing right now, that means we'll see a drop-off in company profitability because they're not getting the sales through, people aren't spending the money, and that then leads to them laying off workers. Now, we've got, we've had an incredible run of low unemployment, and that really won't be sustained if we see corporate profits start to contract, and then they'll try and economise where they can, and that means laying off staff.
Oh, gosh.
And then when you've got more people unemployed, you've got a lot more people who aren't spending money as well.
Let's look, Ian, at whether or not the Reserve Bank has actually gone too far then, because we know, and we're hearing all the time now, aren't we, that households and now retail, of course, as well, they're really starting to struggle.
And I guess one of the problems is that inflation has remained much higher than you would have anticipated. Inflation is still just bubbling around under 7%, and that's way above where the Reserve Bank would like to see it. It's hard to see where it's actually emanating from, and it's not just Australia; it's a global phenomenon at the moment. Philip Lowe, the Reserve Bank governor, has said, well, it could be a result of the pandemic. It might have been from people working at home.
And our job as Australia's central bank is to make sure that this period of high inflation is only temporary. And it's really important that we're successful here. High inflation is corrosive and it damages our economy. It erodes the value of money.
Productivity may have dropped because workers have been in such short supply that companies and firms have put on workers that aren't that productive. We're just not sure what's causing it at the moment. But has the Reserve Bank gone too hard? Well, you'd have to say possibly yes. I mean, from 0.1% interest rate to 4.1% in the space of 12 months it's unprecedented. A lot of economists say, hey, Australia hasn't lifted rates anywhere near as quickly as even New Zealand, which has just gone into recession, by the way.
Yeah.
They're at 5.5. America, way above 5. Look at, all of these other countries, they've increased their interest rates far more than us. But what they overlook is the fact that in Australia, interest rate movements are transmitted through to spending in a much quicker and sharper fashion. And to a very select group of people, mind you, too. It's generally younger people who've just bought homes. And our home loan market is essentially either variable interest rates or very short-term fixed rates. New Zealand has mostly fixed rates and for longer terms. And in America, a lot of the home loans, you buy a house and you take out a 30-year loan, your interest rate doesn't change. So when the US Federal Reserve raises interest rates, it has no impact on you whatsoever. Whereas here, it has a pretty dramatic and very immediate impact, and that affects household spending, that affects our economy and our GDP.
And of course, the US, Ian, the Federal Reserve, it's paused rates for the first time in about a year. The chair of the Federal Reserve, Jerome Powell, though he did say that there could be more to come.
Today, we decided to leave our policy interest rate unchanged. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
And I can see the NAB here is forecasting that there could be 2 more rate rises. So, oh my gosh, what is going on? We feel like we've gone too far, but then there's, predictions that the RBA is going to go further again.
There are. I mean, it's hard to know just how much of this is kind of saber rattling in a way, because expectations plays a major role in economics. If you expect something to happen, those expectations can become self-fulfilling. It's a real phenomenon in economics. It's been around forever. So essentially, you modify, if you think that interest rates are going to go up and there's going to be another 2 rate hikes and you're already struggling, you'll be going, oh my gosh, I've really got to, pull it in. So the expectation that rates will continue to rise is almost as powerful as a rate rise itself.
So, Ian, you mentioned that New Zealand is now in recession. What does that mean for us, if anything? And is that the way that we're heading?
Well, not necessarily, because we've taken a very different approach to New Zealand. New Zealand, back in October last year, forecast a recession for the country for later in 2024. So they've deliberately tipped the economy into recession. They knew that they were going to do that, and they've gone ahead and done it.
Right.
It's just come early. Maybe they're popping the champagne earlier than expected. But their economy contracted 0.7% in the December quarter, which was a really hefty downturn. The March quarter figures have just been released. It only dropped 0.1%, but 2 consecutive quarters is enough to technically say you're in recession, and I don't think things are travelling too well over there at the moment, so we could end up with a third quarter of contraction as well in New Zealand. Whereas here, I think for all the criticisms of Philip Lowe and the Reserve Bank of Australia, they've always tried to ensure that we're going to slow the economy down by raising interest rates, but we're not going to do it as fast and as hard as others because, it does translate here much quicker. And also, we want to see if we can maintain unemployment at around the incredibly low levels that we've had. So they keep talking about the narrow path. So a very different mindset here to New Zealand.
We will do what's necessary to make sure that inflation does not stay too high for too long. And we're hoping we can tread this narrow path that I've been talking about. The economy still grows, unemployment rises a bit, but not too much. But if it's not possible to do that, we will do what's necessary to make sure.
Yeah, okay. I guess the question people want to know the answer to, Ian, is when will things actually get easier for us? When will we be able to pop the champagne, head back to David Jones? When are things going to start to turn around?
Well, there's a whole lot of forecasts out there about interest rate cuts, and they were forecast for later this year. I think that's been put back a little bit now. But, if interest rates have to be cut, it's because things aren't going too well. So there's always an offsetting principle here. Interest rates are cut when people start to lose their jobs. Someone's hardship is somebody else's relief. You'd think we are very close to the top of the cycle of the interest rate hikes, and hopefully we'll see some kind of moderation either late this year or the middle of next year.
Ian Verinder is the ABC's business editor. Economists were surprised when the latest figures showed the unemployment rate fell in May from 3.7 to 3.6%. This episode was produced by Veronica App and Sam Dunn, who also did the mix. Our supervising producer is Stephen Smiley. I'm Sam Hawley. To get in touch with the team, please email us on ABC News Daily at abc.net.au. Thanks for listening.
Subscribe to listen to more free podcasts or download the ABC Listen app and stream ad-free.